Greetings, comrades. The 5 elements of accounting is basically the components of 2 key financial statements. Our income statement, where we report our revenue less expenses and a consequential net profit, and then the balance sheet with the assets on one side and the liabilities and owner's equity, the claims on those assets on the other side. Now, when being assessed theoretically on any of the 5 elements, there's 3 boxes that need to be ticked if the actual element hasn't been specified in the question. First of all, you've got to identify whether it's an asset, liability, owner's equity. You might have to subclassify assets and liabilities into current versus non-current. Then we need to use some of the VCE study design jargon that I'm going to go through to define it using key terms. And then you need to link it back to the actual item, which we'll get to. So in terms of the 2025 to 2029 study design, it defines an asset as a present economic resource, which means it's something that has value, that has the right to produce a future economic benefit, providing it's controlled by the entity of some type of past event, which will usually be a transaction. Let's unpack that further by discussing the definitions of a current and non-current asset. So the key parts here are the underlined parts. This is the jargon that you need to use when you are defining the element in your response. So in terms of current assets, there's an economic benefit. So in other words, they have value. They have the potential to produce a future economic benefit. And this is where we have the distinction between assets and expenses in terms of that future economic benefit versus the consumption. Here's a key bit: that are held primarily for the purpose of sales. So that takes care of inventory. We buy inventory at cost, we mark it up for the purpose of sale, and there's where your gross profit comes into play. Or are reasonably expected to be converted to cash. This is where accounts receivable comes into play, because we've had some sales on credit. That creates accounts receivable. Depending on our credit terms, we reasonably expect, apart from our allowance for doubtful debts, to convert that account receivable into cash when our customers settle. Sold, I talked about that with inventory, or consumed by a business within 12 months. That takes care of your prepayments, prepaid advertising, prepaid insurance. We pay in advance. The economic benefit is the benefit from the advertising, promoting the business, or if it's prepaid insurance, protecting our assets until that prepayment has been consumed. So with your definition of non-current assets, they're also economic resources. They have value. They have the potential to produce a future economic benefit. But the key distinction here between current assets and non-current assets is they're not held for resale. So we're not buying them primarily to mark them up and sell them in the future. So with land, premises, machinery, equipment, any type of delivery van, etc., these indirectly help us earn revenue, because without the land, without the building, without the equipment, without the machinery, without the delivery vans, we can't operate, we can't generate revenue. And these, according to the going concern assumption, will be utilised for a number of years as long as we're getting that future economic benefit. Now, again, the 2025 version of the study design defines a liability as a present obligation of the entity to transfer an economic resource as a result of some type of past transaction. So the obligation means that at some point, generally we're going to either have to transfer funds or work in terms of accrued revenue and that type of thing. So in the case of a current liability, the obligation to transfer that economic resource, which will usually be funds as a result of some type of past event, which is a transaction, reasonably expected to be settled within 12 months. So if we look at accounts payable, when we've bought some inventory on credit, that creates an obligation to our supplier to transfer the funds within 30, 60 days, depending on what their credit terms. Often our GST clearing account will be in credit, which creates an obligation to transfer economic resources once every quarter when we do our BAS statement to pay off those funds that we've collected on behalf of the ATO. A bank overdraft, there's an obligation to square up with the bank and transfer our bank balance so we get into a debit balance. And same with accrued expenses like wages. There's an obligation to our staff to transfer an economic resource in terms of the funds at the end of the week, fortnight, monthly, depending on how often they get paid. And that's going to occur. All of those occur within 12 months, we expect. So we have the same buzzwords for our non-current liabilities. There's an obligation to transfer an economic resource, which would usually be cash as a result of a past event, but we're not expecting to settle that within the next 12 months. So again, the going concern assumption comes into play here. So examples are mortgages, loans, not the kind of current portion of the loan that's repayable within a year, but the rest of the principal, etc. We're not expecting to fully pay that off within the 12 months. We could if we wanted to, we're just not expecting it. And so again, the GC assumption dictates that we classify that as a non-current liability. Now, with owner's equity, the key word here is residual. Residual means remainder. So when we think of owner's equity, we've got to think about the accounting equation, A equals L plus OE. And what that means is if we wind up the business and we liquidate all our assets, the first dibs on those assets are going to be the external claims, and that's the liabilities. So the bank's going to come and basically claim their portion of the assets, particularly if there's a mortgage or property, that type of thing. Accounts payable, they're going to want to get paid. Accrued expenses, the ATO for any type of GST liability. And residual means the rest of those assets go to the owner. So therefore, this is where our capital and drawings come into play. Now, here's where it gets tricky for students when they're trying to define revenue and expenses. This is pulled straight from the study design, so don't take my word for it. Have a look at page 13 of the 2025 study design. This is a copy and paste. So what you need to do when you are justifying why a credit sale, a cash sale, interest received, discount, revenue, etc., why it is revenue, the underlying part of this is key. So you're going to emphasize the fact that firstly, there's either an increase in assets or a decrease in liabilities, not both, one of those two. Usually it'll be an increase in assets. So when we have a cash sale, the increase in the asset will be the cash at bank will go up. If it's a credit sale, the increase in the asset will be the accounts receivable. The decrease in liabilities comes into play for discounts. So if we get a discount for a prompt payment to an account payable, we won't get the increase in asset. We'll instead get the decrease in the liability owing to the account payable. There also needs to be an increase in OE, and that'll be via your net profit, which once we close off our P&L summary, that will bump up our capital. Then we've got this little sentence here that other than those relating to contributions for the owner, and this is where the entity assumption comes into play because that will basically impact the residual claims, but we've got to keep the owner's transactions separate from the business. Again, the study design defines expenses. Have a look on page 13. So what we need to emphasize with all the expenses that come into both the Unit 3 and Unit 4 course is there's a decrease in assets or an increase in liabilities, not both, there'll be one. It'll usually be a decrease in assets. So e.g. any type of cash expense will decrease our cash at bank. Other types of expenses will impact things like cost of sales, etc. There also needs to be a consequential decrease in OE. That will be the reduction in our profit, which again, when we transfer that to the P&L summary, the P&L summary will close that off to capital, and so therefore it will decrease our OE. But the study design goes on further, which is quite helpful to say it encompasses losses as well as those expenses that arise in the ordinary course of the business. So those losses include things like the depreciation that we've claimed for the year, bad debts that have been incurred, etc., and also things like inventory write-downs. So, and the study design actually even specifies a couple of these in their examples, which is pretty helpful. So just as a little kind of summary, let's have a look at inventory in terms of how we classify it. Well, when it's sitting on the shelves, it satisfies the criteria for an asset because it's an economic resource, it has value, and it has the right to produce a future economic benefit when we sell it for a markup. Now, when we sell it, we've got to deal with the cost price effect of that. And so therefore that satisfies the criteria for an expense because there's been an outflow of the inventory, which decreases our inventory on hand. So we've decreased our assets and we have a consequential decrease in OE due to the cost price effect of that. Now the sale price of the inventory, well, it's been marked up. And so therefore, if it's been a cash sale, that's going to increase our bank balance. That's an asset. If it's a credit sale, our accounts receivable balance is going to go up. That's also an asset. And there's also a flow-on increase in our owner's equity due to that revenue effect.